They want to profit the most research supported structure, a 60 to 90 day, slightly out of the money vertical put spread rolled monthly. What? What are you talking about? I thought you just told me that owning single puts and not the spread was the best thing. Why are you now all of a sudden advocating for puts spreads again? And I thought you said it should be 6 months to a year expiration. So why are you all of a sudden saying 60 to 90 days? I don't understand why you're going against what you told me the research was. Yeah, because it literally told me here, right? It's saying the research that it did, classic 1 month, okay, hedge, what the research actually says, study on option, right? Tail hedging, right? Pure, long dated, near at the money single puts were the best. So it said that and then it contradicted itself. So I'm trying to understand. Yeah, you're fair to call it out. That does sound like it contradicted myself. Let me untangle it properly. You're right. There are two separate things I talked about and I blurred them together. What the research actually says, clean version. From long-term academic institutional research on hedging and equity portfolio, if your goal is to minimize drawdowns and improve risk-adjusted returns over decades, then the studies tend to find that single long puts, not spreads, with longer maturities, yeah, exactly, often around 6 to 12 months, strikes around at the money to slightly out of the money, have historically given better risk-adjusted protection than put spreads, collars, or constantly rolling short-dated out of the money options. Yeah, okay, exactly. Right. So if your question was the most effective pure hedge historically for a stock index, yeah, that's exactly what I want. What you asked for, which is not the same as pure hedging, you don't want to be defensive. You want profit from a downturn, but you don't want to get burned badly. Okay, then you're explicitly talking about put spreads. Oh, I see. Okay, so it's actually saying two different things here. I understand. So what we want is we actually want it to hedge, right? So if we're going to own TQQQ on a regular basis, then we would probably want to own puts to hedge that position that should make us some money on the way down. Whereas the phrasing that I was saying was like, oh, we just want to make money on the way down. So I guess it depends, right? Like, do we want a strategy that is hedging and we're protecting ourselves, or do we want to have something that's like actually going to make money? So I guess that's the difference here. I would say I would prefer to do this, right? Okay, so I wouldn't buy the put spread, right? Buy puts to buy the puts. Okay. So and then if we have long dated puts, I wonder how we should be doing this. So it's saying 0 to 15% out of the money. Okay, so let's say strikes around. Okay, so let's say strikes around at the money to slightly out of the money, say 0 to 15% out of the money. And then longer maturities, often around 6 to 12 months. That's what we want. Right? Okay, so we have a strategy here. This is what we want to build. It's going to own TQQQ if we're above the 200-day moving average. We're going to use 90% of the account for that. And then we're going to use the other 5% of the account. So we're going to have a little bit of cash sitting around, which, maybe we don't need to do that. Maybe we'll go 7%. We'll have a little bit of a cash buffer. Just in case, because you kind of want a little bit of cash for trading. It makes things a little bit easier to trade if you leave a little bit of cash around. If I found that, right? And then it's going to use 7% of the account to buy puts that is described like this below. You might have to sell some TQQQ in order to buy the puts if you don't have enough cash or if the ratio is off, right? And then strikes around at the money. And then we also need to say buy SPY puts. So the reason why I'm saying SPY puts, we could also say puts on QQQ. Maybe that would be better. I'm not sure. Maybe let's buy QQQ puts. So because we're buying TQQQ, that's a triple leveraged Nasdaq on the way up, and then we buy puts on the QQQ, which is also a Nasdaq. So they're related to each other and they're kind of straddling that. Um, I was going to say SPY because SPY options are very, very liquid, but I think we'll be fine buying the QQQ puts. Okay, let's generate this. Go ahead. Let's see the AI actually build this out. And we'll see what happens. I'm actually quite curious to see what happens with this. And we'll give the AI, it usually takes about a minute or two to generate a strategy. So we'll let that happen and then we'll be able to run a back test. We're actually a little bit over our 1 hour mark here, but I'm just curious. I don't know if you guys are curious. I'm very curious to see how this strategy works out because this is a strategy that I've actually thought about for quite some time. Having this kind of strategy where you own a leveraged position, right? So you make a lot of money on the way up using leverage, and then you have a put option that's kind of cutting off the bottom, right? So if things go really bad, it like protects you, right? I think that would be a pretty interesting thing to do. All right, so let's see how this does, and we can actually even compare this to our regular strategy that simply buys a 200-day moving average and that's it, right? Or buys TQQQ if it's above the 200-day moving average. All right, so let's see if that is the case here, right? I wonder if it's going to outperform that strategy or not. All right, we're going to give it a few more seconds here and we'll see what it generates. I'm actually very curious to see what it makes and then how it performs. And I think this back test will probably take a little bit of time to run, but we'll see how this actually does. What do you guys think? What do you guys think about a strategy like this, right? Where we buy TQQQ, but only if it's above the 200-day moving average. And then we also own some put options as well. What do you guys think about this? Do you think this will do well? Have you guys ever tried trading anything like this before? Let me know. You could type it into the comments. You could type it into the chat. Let me know. Have you ever traded a strategy that owns put options on a regular basis? I'm really wondering whether you guys have ever done this before. So put it in the comments, put it in the chat. Have you ever owned put options long term on SPY or QQQ to hedge your portfolio? Is that something that you've ever done? Because what we're doing here is we're buying put options on QQQ that are slightly out of the money with a 6 to 12 month maturity, right? Have you guys ever tried a strategy like that to hedge your portfolio? I feel like that would be a pretty interesting thing to do. Let's see if this works, right? Okay, so here's the strategy. The strategy aims to ride the long-term uptrend of the Nasdaq 100 via TQQQ while carrying a steady layer of portfolio insurance with QQQ put options. It allocates up to 90% of the account to TQQQ when the price is above the 200-day moving average and exits entirely when the price falls below that average. Separately, it maintains a 7% allocation to longer-dated QQQ puts to help cushion sharp declines. So the strategy works by monitoring these key conditions. TQQQ price must be above the 200-day moving average. The hedge uses QQQ puts when the expirations are around 6 to 12 months and strikes at the money to about 15% out of the money. It buys TQQQ toward the 90% margin. Okay, very cool.